Hey guys, welcome back to the channel. Thank you for joining me once again. Today is Sunday, March 7th, 2021. Time is flying by. I can't even believe we're almost at the end of the first quarter of 2021. Um, hey, look at me. I'm in a bubble. It's the last bubble we were in. I'm still in a bubble. Uh, there's the next bubble, right? Holy, I don't know who the next guy will be, but I assume he's much taller than me because I'm not going to fit in that bubble. I only fit in this bubble. Today, we're going to go over my predictions for what is going to happen in the housing market in 2021 and 2022. So if that topic interests you, please stick around and get my predictions at the end of what's going to happen this year and next. And you might want to buckle your seatbelt because things are going to get interesting. Before I get into it, guys, let me just implore you, please, kind sir or madam, if you could just hit like and subscribe on this video. So that will help me kind of grow this audience and reach more people that are interested in the topics that we talk about on this channel. Please, thank you so much. And now for bubble news. So I first want to share with you why I wanted to do this video. The reason why, and it's incredibly important to me, not only just for the channel, but it's important to me for personal reasons because I'm attached to the outcome. So I'm passionate about it. I guess the main reason why is because most realtors suck. And I don't mean that in a bad way, although I don't know how sucking can be put in a good way. But most realtors do suck because they're just happy-go-lucky people that just want to sell you a home. And most of them lack the ability to have an honest conversation about the housing market and whether or not it's inflated. So this is the typical realtor response when you say, yeah, I'm interested in purchasing a house and I'm shopping for a realtor. Do you think that the housing market is going to crash in the next year or two? Here's their coined response most of the time. That's a possibility, although because interest rates are so low, if it's a 30-year home that you're planning to find your forever home, it's really no issue because interest rates are so low, it's not going to matter what the price of the home is, right? In other words, don't look at the price of the home. Forget about that. What is it, $400,000, $500,000? Don't worry about that. Yeah, it's inflated. Look at the payment. The payment is what matters, right? It's garbage because in 5 years, and we all know this, life kind of ebbs and flows. None of us can predict where we'll be in 5 years. We all have like that image in our mind of where we're going to go in our life and what we would like to see happen. And we can even set intentional goals to get us towards that 5-year image in our minds. But because this is such a windy, unpredictable road that is life, in 5 years, that forever home that you purchased at an inflated price you could be in a situation where you're like, hey, I got to sell the house. Something has happened. I need to move back to the East Coast or back to the West Coast where my family is. Somebody got sick. Someone died. Things happen. And you have to make a change. And now that, oh yeah, at the time, that inflated price that you didn't want me to look at, and I was just looking at the payment, well, guess what? Now that price really matters because I'm going to sell my house, but I bought the house when the housing market was inflated, and 5 years later, the market has corrected. And so I bought the house at $425,000. Now the market has corrected, and 5 years later, the house that I've been paying these big payments on is only worth $300,000. That's $125,000 loss. I'm going to take a huge haircut on that, and I got to pay that. So I would just implore any of you, if you're considering buying right now, this is clearly a bubble. We are near the height. No one can tell you when this bubble is going to pop, because no one's for certain when the federal government is going to stop propping up the real estate market. But they absolutely are propping up the real estate market, and I'm going to demonstrate to you how they are propping up the real estate market. It's not just realtors. It's a narrative that's being put forth by a lot of different entities. For one, Zillow. Zillow is just like, oh, I just have a terrible view of Zillow. They're like they're like a blue collar, uneducated, you know. I'm telling you right now, home prices are going to keep skyrocketing. Yes, they are. You know, I mean, that's just how I view Zillow. They're just kind of low rent. And I don't mean that in a bad way. That's the second time I used that. But honestly, it's like, I use Zillow, so let me just put that out there. Sometimes I go there to see what their market projections are, or what their what their estimated prices are on the homes that are nearby my location. But it's not just Zillow that's pushing this garbage that home prices are just going to keep climbing. Ooh, it's real estate economists, Ivy League educated people that you should be really intimidated by because they're much smarter than you, right? Don't forget that a lot of these economists, these real estate economists, are paid to come up with a conclusion that is favorable for the industry, especially when they're paid by the industry to do so. That's the problem. Listen, I can come up with any numbers that you want if you pay me enough, right? That's what's going on. And I'm not going to exclude the National Association of Realtors in that. They're pushing the same crap. Everything's going to be fine now. It looks like we're looking at real positive numbers for real estate. Really? Well, guess what? I agree with them. I know you didn't expect that, right? Like I've just spent all this time bashing them. I agree with them. In the short term, they are absolutely right. What is it? Yesterday, we found out we came one step closer, guys. I told you this in the last video. It's inevitable. $1.9 trillion stimulus package is coming right to you. It's coming to you. You're going to get $1,400. Happy days are here again. Man, that's just awesome. So, interest rates moving forward, short term, will continue to remain relatively low. Supply will continue to remain relatively low. Demand will continue to be relatively high. So in the short term, housing prices aren't going anywhere, except they might tick up a bit. Long term is a different story. And in order to find out what's going to happen long term, there's a couple key factors that we have to consider. And the first key factor to figuring out what's going to happen long term is going to be, what is the real economy doing? What is the real economy doing? I'm not talking about that fake economy, that fantasy called the stock market. That's the fake economy. It's not real, right? Because when the stock market was attached to reality, you could purchase some stocks in a company, and that company was given a valuation on certain criteria. Are they profitable? What type of debt do they have? What is their projected growth? Right? But here's what's happening in our stock market. A company that just a year ago was valued at half as much as what it's valued today. And in that year, they've laid off thousands of employees. They've cut their productivity almost in half. Okay, so they lay off a bunch of people, they cut their productivity, they're not making as much, and then their revenue streams have dropped. In some cases, their revenue streams have dropped almost in half. And somehow the stock market now evaluates the worth of that company at double of what it was worth last year. Okay, so that is the fantasy economy. That's a fake economy, stock market. The real economy is jobs. Employment is down. Revenue is down. You know what? Let me go back to that first one. Employment. I'm amazed. Like, what, this past week, 730 or 50,000? I get lost in the numbers sometimes. I believe it was 730,000 new unemployment claims. Okay, we haven't dropped below 700,000 new unemployment claims since March of 2020. It's almost been a year. Every single week, 700,000 plus new unemployment claims. So the real economy is jobs. And it's not looking good. The real economy is revenue streams. The real economy is labor participation rates. Well, what are labor participation rates doing? What are they doing? Let's look. Is there a reason to be optimistic? Like, I want to be optimistic. I don't want to be Mr. Doom and Gloom. So let's look at them. What are they? Guess what? And I'll go over this later. 61%. That's the labor participation rate right now. You know how far back in our nation's history you have to go to find a time where labor participation rates were at 61%? You have to go back to 1976. Okay? So what's going to happen? There's a lot that's going to happen in real estate. And all of these factors add up to something. Like, it's not just one particular statistic that I can throw out to you guys. It's the preponderance of the evidence that brings even the greatest opposition. Somebody who has a voice that's like, no, you're wrong. Real estate's only going to the sky. Well, right now, I agree with you. Real estate is going to the sky. But the bubble will pop for all of these reasons that I just mentioned. It's going to explode, and it's going to be devastating when it does. Okay? So those people who either are unemployed, they're in forbearance, or they just haven't been making their payments, guess what? They're going to be selling their house. If they're lucky, if they're one of the lucky ones to actually have some equity in that house still. Okay, maybe it's people who just, and there are, this is the American story. People who just they can't afford their lifestyle anymore. They went and purchased that home that was their big, beautiful dream home, right? And they way overspent on it. They can barely make their house poor. Their house broke. Their house poor. So all of their money every month just goes towards making that mortgage on that big, beautiful home and keeping that image up, right? For friends that probably don't like them anyway. That's the pessimist in me. It all amounts to there is going to be supply hitting the market. And real estate is like any other market. It is ruled. It lives, breathes, and dies by supply and demand. There is no exception to that rule. So now I'm going to get into, and listen, a lot of times, all my past videos, I've been front and center. I kind of feel like maybe you don't need to see my fat butt in front of here all the time. So now let's get into some of the numbers about forbearance, because there seems to be this BS kind of, the same thing happened back in 2006, if you will, where people were like, right before the subprime mortgage crisis, people were like, well, it's not that many people. It's not that many people. Not that many people. That many people got loans that didn't deserve it. Really? You're full of crap. Same thing is happening right now. Like, it's not that many people in forbearance. Well, we know what the numbers are, and I'm going to show you what the numbers are. But don't believe that BS. If there weren't that many people in forbearance and it didn't matter, like if the economy could take it, if the real estate market could withstand the blow of the supply hitting by allowing these people to go into foreclosure, the government wouldn't have kicked this moratorium on foreclosures down the road, by my count, 5 times now. Why? Why would they continue to kick that can down the road? They wouldn't. They would let the market correct itself, because you have to. You have to allow that market correction to take place. But they're not going to do it because they know. They know when that crash happens, it is going to be devastating. And it's going to happen regardless, because the government cannot continue to prop this up forever. So what are the forbearance numbers? Let me disappear myself. Let's talk about the real numbers, guys. So here's some real numbers for you guys. Black Knight. And if you haven't heard of Black Knight, I encourage all of you to go out and check out Black Knight, as it relates to their numbers in real estate and what's really going on in the real estate market. Black Knight is like something you would be remiss if you overlooked it when trying to evaluate where the real estate market is going, because they have a ton of great resources and good numbers. Although they still try to push a narrative that's on the upside. Like they still, for instance, this first sentence is crap. While delinquencies continue to improve slowly and steadily, I'll show you why that's actually incorrect in the next slide. Some 2.1 million homeowners remain 90 or more days past due, but not yet in foreclosure. Still 5 times higher than pre-pandemic levels. You see how they left out higher, but whatever. Something else to consider. So they're saying at the current rate of improvement, 1.8 million mortgages will still be seriously delinquent at the end of June, when foreclosure moratoriums on government-backed loans are currently slated to lift. I got news for you. Guess what? I think they've already extended it. Okay, so I think they've already extended it now to the end of 2021 on government-backed loans. So you literally have all year long, and that kind of goes to my point, what I was talking about. Like short term, nothing's going to happen, and short term being through 2021. We're just not going to see much of a change, because the government's going to keep kicking this can down the road, and they've made that abundantly clear. But let's talk about forbearance. And is that true? I mean, is it true even according to Black Knight's own graphs? Like, are forbearances really going down? I wanted to know. So guess what? Here you go. Significant unknowns remain, one of which is the impact such extensions, like I just talked about, will have on the overall recovery. We've already seen evidence of forbearance starting to erode borrowers' equity positions. And the banks know that. The banks know that your equity in your home isn't going to be worth crap. And I'm going to touch on that here in a minute. But plus, the forbearance landscape itself continues to evolve. So check out this active forbearance plan. See this? This line here represents the total. That means all loans, Fannie, FHA, VA, other. This is all those loans considered. So initially they skyrocketed together, and then look what happens here. I would say probably right here, June, roughly. They start to tail off. They spike a little bit, but then now we're seeing a very gradual and real. It's tangible. You could see it drop off on forbearances. Okay, and then what's really interesting is right around November. Okay, November 1st. Look, they flatline. They flatline, and really, I would say, is this the new baseline? It's the new baseline for forbearance because there's really no change after November 1st. It's just a steady baseline. Now, I would assume, and I think it's a reasonable assumption, that all these people up here that have eventually dropped off of the forbearance program are people who, one, either were unemployed and they because of the health crisis, and they um, applied for forbearance just as a cautionary measure in case they couldn't find employment, or they applied for forbearance just in case. Like, I'm not unemployed, but I could lose my job. Let's see what happens. So all those people drop off between, let's say, May 22nd and this big dip here, October. But you come to November 1st, it's pretty much a straight line since November to now. There's no drop in forbearance. It's not dropping any more, kids. Okay? So anybody that tries to sell you that crap is full of it, just so you know. What makes up a healthy real estate market? Usually, healthy real estate markets are made up of first time buyers entering the market. So you can tell whether or not your market is healthy by, is there an uptick in first time buyers or is there a downtrend? According to the National Association for Realtors, typically in a normal market, first time home buyers make up for about 40%, 40% of all purchases. But these kids are up against some tough numbers because right now you've got a bunch of people that are looking to buy a home that are not first time home buyers. So these people typically have a large amount of cash to put down. They also are up against competing bids. And according to the NAR themselves, so it's normally at 40%. You can look historically right now. Recently, it's been very low. Even in 2018, it was low. But here it is. Here we are. What, September 2020? It's at 31%. But they're still going to try to paint it in a good light, right? Like, oh, that doesn't mean anything. Just don't even bother looking at that. And it's pretty much everywhere you look. So here we are at the mortgage reports. Okay. Don't be too worried about rising home prices. In other words, what I said at the beginning of this video, kids, don't look at the home price. Look at the payment. So these are recent headlines that they even cite, and these are facts. U.S. home prices up 15%, largest growth since at least 2005. The reference there is right there. July home sales spike a record 24.7% as prices set a new high. Look, I'm not going to keep boring you, but these people, they continue to push this, hey, don't worry about the price. Only worry about the payment. Should the highest ever headline scare you off? The short answer is no, according to these people. Though through these turbulent times, the real estate market has been a high point for the U.S. economy. Yeah, crap. It's only because it's being propped up. Even as home values continue to rise, low mortgage rates lend shoppers more buying power. In this way, buying a house has remained largely affordable even throughout the worst moments of the pandemic. Okay, so let me put something into context for you. So I hear this all the time. Well, even if there is a market correction lowdown, the problem is that people have a ton of equity in their homes, and they're going to be able to use that equity and just sell their home. And there's not going to be a bunch of homes going into foreclosure. They're just going to sell their home, and even if they take it at a loss, they still made money because they have all this equity in their homes. Well, guess what, guys? If you purchased a home in the last 7 or 8 months, you don't have any equity. There's no equity there because home prices have been elevated to an extreme more than 7 months. So you bought a home at the highest level that we're going to see for quite some time, and you have no equity. If you purchased a home in the last 7 months, congratulations, you have no equity. And if and when there is a market correction, you are not going to have a choice, especially if you become unemployed or the market collapses and there is this huge economic downturn. You're going to be forced to sell. And guess what? Just like in 2006, you don't have equity. There's nothing there. You may just walk away. Can you say subprime mortgage? Repeat? You may just walk away. So the banks know that there's no equity in your home. They already know it. They're expecting it. Why? Why would I have that opinion? Well, because they're telling you right here. Look at this. Here it is. As HELOC availability disappeared, alternatives for home buyers who need cash. You know what HELOC is? Home equity line of credit. Why are they disappearing? Why are the home equity line of credits disappearing? They're disappearing because the banks know there's going to be a market correction, and if they have extended a loan to you on equity in your home, and that equity disappears overnight, when the market corrects, you're still on the hook, but you're less likely to pay it, much less likely. So it's self-preservation for the banks. This was according to Bankrate. And let's see, July 16, 2020 is when this article was put out. So basically they're saying that the banks are, hey, we're not going to give out home equity line of credits anymore. And why should they? They learned from the last time. People treating their homes like it's an ATM. And people are doing the same thing now. What's the evidence of that? Well, to me, the evidence of that would be, home improvement. Look at how many home improvements have taken place while the stupid health crisis has gone up. Like Home Depot has just gone crazy. Why? Well, because people are bored at home. They're like, screw it. Oh, let's take out a home equity line of credit. Or let's just refi. How about that? We can refi and take a bunch of cash out. And now we can remodel that kitchen. And honey, those fluorescent lights in the kitchen that you hate, I can redo all that. Let's do recessed lighting. Get you some of that nice glass tile we'd be seeing on HGTV. We'll get you all done up. Guys, this is a bubble. And you can clearly see it. I mean, the stats don't lie. So look at the acceleration here. Guess what this was right here? You see that heavy acceleration? That was the subprime mortgage crisis. You got a pulse? I'll give you a loan. You got that loan. This is where we topped out. Look at how minute that crash looks now. Looking back at the subprime crisis, looking back at the Great Recession, look at how minute it looks compared to this melt up. This is where we are now. It's just going straight up. Let me explain something to those friends and family members. If you've stuck with me this long in the video, which I appreciate, I love you to death. The thing about it is that no markets, there is no market that just goes up. It just doesn't happen. So right now, everybody's caught up in this euphoria, like, yes, it's only going to keep going up. No, it's not. It will correct. But why would it correct? Well, because all those pressures I mentioned. Revenue is down. Employment is down. Income is down. Labor participation rates are down. The preponderance of the evidence clearly demonstrates there is something coming, and that something is going to come as soon as the government stops making all of this look okay. Let's talk more about labor participation rates. Would you like to? I'd like to. I'd like to see if I'm right or am I wrong. Look at this. Okay, so we clearly understand what happened here, right? Boom, health crisis hits and things are looking really, really bad. Okay, but so that was April of 2020. What happens now though? Where are we at now with this booming economy and everything's coming back? Everybody's got that vaccine in their arm. People are going back out to restaurants. This is going to be a V-shaped recovery. Really? Look at this. This is where we are today. February 2021. 61.4% participation rate. So how far back do I have to go to find when the economy was kind of at that 61.4% participation rate? Let's see. Well, it's certainly not in 2000. In fact, go ahead and skip that whole decade there because that's not going to work. Skip that decade. In fact, I would have to go all the way back to 1976 to find a time when unemployment levels were equal roughly to where we are now. 1976. And we're supposed to believe this narrative that everything is fine and the real estate market is going to flourish. Guys, if you have a labor participation rate at 61%, who's buying your overpriced homes? Eventually all that dries up. And this talk, well, there's a great migration from the big cities like in the big states like California where you're overtaxed, or New York. People are fleeing to the Midwest and the suburbs. Yeah, but eventually you can't sell your home in California for an inflated price because no one wants to buy your home in California at an inflated price. So that's going to end too. All of these things are going to, they're going to come home to roost. This can't continue. Now, this last chart is very interesting. This is the last chart I have to share with you today. So this is the IRS's own publication. It's the 6961 publication. And this is their prediction or their projection, if you will, of how many W-2s they're going to receive in the years ahead. So initially, you can see for 2018, they projected a level that looked something like this. That's pretty steady. But then they revamped it because they realized they were being way too optimistic. But not as optimistic as they were in 17, but they were being too optimistic. So you come down here to 2019 and they're a little bit more realistic. But guess what happens? The health crisis hits. And this is not a politician. This is not some, lobbyist or some media trying to push a narrative. This is the IRS's own numbers. Look what happens. The health crisis hits, and now they project for 2021 the amount of W-2s that they will process will decline by 37 million. 37 million less W-2s than they had initially anticipated. But that's not the most disturbing thing about this chart. The most disturbing thing about this chart is, look, they project for it's going to take 8 years, okay, to even get back to somewhat normal, to get back to where we were before the health crisis, getting those W-2s in. So in other words, 8 years to gain 37 million when we lost them in a number of months. Okay, now I'm gonna return my fat butt to the screen so I can give you guys the lowdown. So here's the lowdown. The lowdown is this. This channel is not financial advice. I'm just some guy on YouTube. I might be right, and I could be wrong. But I believe these things with my whole person. And it's not because I'm like buying into a narrative. I'm just looking at the facts. I'm looking at the real numbers. I'm not listening to a media opinion, or I'm not listening to an economist that was paid to come up with a finalized outcome that's favorable. I'm just looking at the real numbers, guys. You know what's interesting to me is that here we are, we're about to get another 1.9 trillion in stimulus. There's certainly going to be a bump. You're going to be like, oh my gosh, look at the economy. It's just doing splendid. Meanwhile, we're all going to get $1,400. You know what Walmart is doing? Walmart is like, hey, hoist the sails and man the bow. Like, get ready because it's coming. At $1,400, we're going to sell you some really good Chinese goods, right? And that's really even a greater point is like, what does all this stimulus money do? Does it create jobs? I don't think it does. Does it really help the person, the middle class person that's maybe considering buying a home? No. It falsely props up all assets. It props up a zombie stock market. It's going to stop, though. And it also enriches foreign nations, like China, who sells the majority of all their products through your local Walmart. And the majority of people, of Americans that live paycheck to paycheck, will be taking that $1,400 and going directly to Walmart to buy those Chinese goods. This market will correct. The stock market will correct. The housing market will correct. It's no skin off my back. You want to go buy a home at these inflated prices? You're going to lose. That's my prediction. I don't think it'll be in 2021. I think by the start, they can't kick this can down the road forever. So I think by the start of the fourth quarter of 2022, the real estate market's going to look a whole lot different. By 2023, the fat lady has sung. And those homes that were going for $400,000, or better yet, those starter homes, 3-bedroom, 2-bath, kind of plain Jane, that in my area are going for $320, are now back down to $150, $160. That's what type of correction we are headed towards. Now look, all real estate is local. So there will be markets in different pockets of the country that thrive, and they're going to thrive anyway. North Scottsdale, in my neck of the woods, is certainly always going to thrive. Okay, because there will always be rich people that are mad at their money. If you're mad at your money, you move right to Scottsdale. If you're just a working schlub like me, you're a blue collar folks who just you work hard and you try to earn an honest living and pay off your mortgage. You don't want to buy in this bubble. That is the lowdown, because that's how they're going to steal our wealth. And I beg of you, don't buy into it because it's all garbage. Wait, and you can turn a crisis into an opportunity because they're really the same thing. And that's what I hope for all of you. Listen, I've rambled on enough. I love all you guys, and I'll see you next week. Take care.